Hello everybody, Professor Barth here, Associate Professor of History at Arizona State University. Welcome to the Dollar Report, June 2023. Big news today, the FOMC, Federal Reserve, or Federal Open Market Committee, announced that they are pausing rate hikes, which was the expectation. However, forecast further increases in 2023, which was definitely not expected. The Fed forecasts 2 more hikes in 2023, taking rates as high as 5.6%. And the way it worked, the FOMC, the 18 members of the FOMC, gave out their forecast for further rate hikes. 4 members of the FOMC saw 1 more rate increase this year. 9 of the 18, so half of the members of the FOMC, expect 2 additional rate hikes in 2023. Right now, the upper limit is at 5.25, so that would take us to an upper limit of 5.75%. 2 members added a 3rd hike, while one saw, this is phenomenal, one saw 4 more hikes in 2023. Wow, quite the hawk on the FOMC. A member of the FOMC forecasts 4 more hikes. What's going on there? But 2 said 3, but half of the FOMC, more than half, expects at least 2 rate increases this year. That was totally unexpected, and markets are responding accordingly. Only 2 members signaled that they do not expect any further hikes this year. Now, this is getting less attention, but in the forecast, they also changed their outlook on a recession in 2023. The FOMC is no longer forecasting a recession. If you remember from previous FOMC meetings this year in the spring, they forecast a quote, mild recession later in 2023. That has now been revised, and the Fed is no longer forecasting a recession in 2023. Take that, with a grain of salt, I suppose, but that is important. But nonetheless, the markets do not like this news. Dow drops 400 points. As of right now, actually, Jerome Powell is conducting his press conference, so I don't know exactly what he's saying there. Knowing Powell, given Powell's history, that is, he's going to play it very cautiously. He'll probably explain that, well, that's just a forecast about the further rate hikes, and some of the members don't agree with that, and we have a diversity of views on the committee. But certainly the markets don't like it. More on that in a moment. Also yesterday, the CPI came out for the month of May, and the CPI was a mixed bag. Total inflation is down year over year to 4%. Core inflation is a different story. Core inflation, as we'll see here in a moment, remains stubbornly high and is really not moving. So the CPI report was a mixed bag. I suspect that had something to do with the Fed's more hawkish stance today. Here's a graph of the year-over-year consumer price index, total CPI since November 2020. So undoubtedly, it's gone down. We're down to 4% year-over-year, down from a peak of 9% last summer. If you look at month over month, a fairly optimistic picture. We've had a season now of lower month over month inflation in total CPI. 0.1% for the month of May. That's certainly lower than what we saw in 2021 and the first half of 2022. There's another way to look at it, line graph versus bar graph. So down a bit. Core is the exception. Now remember, core CPI excludes food and energy. Why? Well, food and energy are said, accurately so, to be more volatile sectors. And so if you want to get a true picture of where the dollar is and where prices are, you take out food and energy and you can get a more accurate, again, picture. Well, core CPI year over year, not so good. Look at this. This is from November of 2020 through May of 2023. And you know, it peaked in 2022, but it's not down that much year over year. There's in line graph form, certainly a different looking graph than total CPI. So core CPI remains stubbornly high. And then here's zoomed in. This is zoomed in from January of 2022. Why January 2022? Well, this was around the time that the Fed began to raise interest rates. Now look at that. You would think that the raising of the federal funds rate by 5% over the course of the last year and a half would have had a more meaningful impact on core, but it hasn't. This is pretty steady year over year core CPI since the Fed began its tightening cycle. Very illuminating graph there. And then if you look at month over month, and the advantage of month over month, you get to zoom in what happened in that month. Core CPI month over month since the end of 2021, and where's the disinflation, as they call it? Where is the decline in core? You don't see it. You don't see it. Notwithstanding unprecedented rate hikes, not in a nominal sense of unprecedented as far as the total rate, the federal funds rate itself. The federal funds rate has been way higher than 5.25%, of course, but the acceleration has not been seen since the early 1980s. Notwithstanding that, core CPI month over month remains quite high. This is since the tightening cycle in January 2022. Where's the decline? It's not there. There's in line graph form. Not there. So that's a problem for the Fed and for the dollar. Now, won't go through all these. These are individual commodities on the CPI index. The good news, food seems to have settled down a bit. Okay, total food went up 0.2% in the month of May, 6.7% year over year. Let's not forget, however, that in any normal year, 6.7% increase in the price of food is completely inappropriate. Okay, but it is lower than what we've seen in previous months. It's going down, albeit slowly. Here's the month over month change in food prices. In the month of May, food prices rose 0.2%. Compared to April was also 0.2%. March was 0.1%. Of course, look at in 2022. Look at this. This was nuts. For basically the first 2/3 of 2022, food prices were jumping about 1% every month. Thankfully, that's chilled out a bit. Energy has gone down substantially, and this is one reason why total CPI is lower. It's now 4% year over year. Why? Because total CPI includes energy. Core does not. When you put energy in there, energy prices have gone down again substantially. Gas is down almost 20% from May of 2022. Energy total is down almost 12% since May of 2022. Natural gas down and then you look at month-over-month change in energy prices. Since the tightening cycle, certainly energy prices have not gone up as much as some people had feared. And then you have other various commodities. Transportation, especially motor vehicle maintenance repair, up 14% year over year. That's quite high. Motor vehicle insurance up 17% year over year, quite high. Airline fares are down. This was a big contributor as well to higher core prices, or the higher core rate. Shelter up 8% year over year. Now, early last year, I was very critical of the way the Bureau of Labor Statistics calculates shelter, because they had a really low rate. They said it was that shelter had gone up only 4% year over year. I was like, that's totally inaccurate. That's not correct. Now it's been corrected a bit to, now they say 8% year over year increase in the price of shelter. Shelter makes up 1/3 of CPI. Okay, 1/3 of CPI went up 8% year over year and went up 0.6% month over month. A significant increase month over month. Again, 1/3 of CPI. So that was responsible in a large part for the higher than expected core numbers. There's the federal funds rate. The Fed announced today they're pausing rate increases, again, only for now, but we're at an upper limit of 5.25%. Let's not forget, in early 2022, the upper limit was 0.25%. So this has been a very rapid increase in the federal funds rate since early 2022, after a good 2 years of basically 0% interest rates. The Fed's balance sheet has gone down only a little bit. That jump you see there was after the banking crisis in this last spring, but it's gone down since. This is the Fed's balance sheet since the tightening cycle in early 2022. So we have had some downward movement, again, notwithstanding the temporary spike there during the collapse of SVB and others. But, if you zoom out, it's like, okay, not a huge reduction in the size of the Fed's balance sheet, which just absolutely went through the roof during the pandemic. And this, of course, was what was responsible for the inflation. The money supply since the tightening cycle began in early 2022 has gone down 7%. So M2 has fallen by 7% since the Fed began raising rates. Significant, but again, you zoom out, and since early 2020 up to the present day, M2 is still up 32%. So there was just so much money flooding the system after 2020 that even a 7% decline in the money supply really only makes a dent in how much new currency has been placed into the system. So banks are tightening lending standards. From the Wall Street Journal, lending standards tightened in the first quarter of 2023, banks say. I think we've all noticed that. The 30-year fixed-rate mortgage has remained fairly steady around 7%, or between 6 and 7% since the fall of 2022. Interestingly, since March, or since the spring, home prices have actually risen for 2 straight months. This is from a Wall Street Journal in May. Home prices rose in March for a second straight month. Why is that? Well, there's a shortage of homes for sale. If you locked in a mortgage at a really low rate, as my wife and I did, we're not selling. Why would you sell if you had that low mortgage rate, and so the number of houses on the market are a lot lower. And with that shortage, you have buyers competing with one another to buy what is available. Meanwhile, much of this demand has been channeled into newly built homes, which has led to a construction boom. The Dow has been fairly steady through this tightening cycle since early 2022. Had a dip there in the fall of 2022, but then bounced back up. The Dow's down 300 or 400 or so points this morning. This was before the FOMC announced their decision, about 34,000. The Dow Jones, the 10-year Treasury, as well, has been actually remarkably steady. A lot of us didn't expect that. I didn't really expect that. It's been hovering between 3.5% and 4%, the yield on the 10-year since last fall. Of course, the tightening cycle in early 2022 through fall of 2022 led to a very rapid increase in Treasury yields, which placed a lot of banks who had poor risk management in some trouble. But since fall of 2022, yields have been fairly steady, and the labor market remains very, very tight. Unemployment rose, I think, a little bit. Here we go, 3.7% in May, but 3.7% historically is still quite low. And so with the tight labor market, the Dow is fairly steady. The Treasury yields really remain relatively low, all things considered. Home prices are, yes, there's a shortage, but the housing market is still, home prices are still rising, it seems. That, the Fed has determined for now to pause rates, but has opened the door now to more increases. Interestingly, there's a great article in the Wall Street Journal yesterday and this morning making the case that the Fed should raise rates and that the federal funds rate and monetary policy in general has not been restrictive enough. This article, Stock Market to Fed, you haven't done enough. And the author of this article points out that while in nominal terms, the federal funds rate, increases in the federal funds rate is, again, unprecedented since the early 1980s. These are other tightening cycles, and you see they not nearly as rapid or drastic as the tightening cycle we've seen since 2022. However, in real terms, the rate increases have actually not been as much as it may seem in nominal terms. In real terms, the federal funds rate hikes have been comparable to other tightening seasons in Fed history, and in some cases even lower. Now, what does he mean by this? He says, well, like, let's say, for example, you lock in a 5% interest rate over the coming year, okay? 5% interest rate over the coming year. Or to use a more concrete example, you're a borrower and you borrow $10,000 at 5% interest, okay? That's the nominal interest rate, 5% interest. The following year, you repay that loan, 5% interest on a $10,000 loan. The principal plus interest equals $10,500. Okay, I paid 5% interest. Well, not really, because in this hypothetical scenario, inflation over the last year was also 5%. So if you have a 5% interest rate over the coming year, and during that same year there was 5% inflation, you've effectively paid zero interest on that loan. You see what that is? That's called the real interest rate. Real interest rate is when inflation, or it takes the nominal interest rate and subtracts inflation. Sometimes it can be a negative real interest rate if inflation is higher than the nominal interest rate. If you have negative interest rates, that encourages borrowers, obviously, because why not borrow money if you can borrow money very cheaply at a rate that is lower than the rate of inflation? Well, the author of this article in the Wall Street Journal points out that when you look at not the nominal rate increases since early 2022, but if you look at real rates, actually, rates have not risen much at all. We're still only at 5.25%, the federal funds rate. And he says, based on a 5.3% increase in consumer prices, excluding food and energy, that is core, in the past 12 months, the real rate is around zero. Isn't that interesting? So that if you take real interest rates into account, actually the federal funds rate is not as high as one would think. That also might explain why the FOMC decided to, pause rate hikes to forecast future rate hikes in 2023. Also, a couple weeks ago, the FOMC released their minutes from the May meeting. We won't have the minutes for the June meeting for another few weeks. But the minutes from the May meeting were quite illuminating, detailing some of the discussions. Of course, there are private discussions that happen that we have no idea what is said, but the official minutes, participants agreed that inflation was unacceptably high. They commented that data through March indicated that declines in inflation, particularly for measures of core inflation, had been slower than they had expected. So again, going into the mind of why is the FOMC doing what they're doing? This is the May meeting. However, this is still the same FOMC. Core inflation, the declines in core inflation, have been slower than they had expected. Participants observed that although core goods inflation had moderated since the middle of last year, of course, it had decelerated less rapidly than expected in recent months. And certainly the latest CPI numbers that came out yesterday did not give them any more confidence. Core remains high. So this outlook that we saw in the minutes from the last meeting this would remain true for the latest meeting. I think that tells us why or explains the forecast that we received today. Participants referenced the possibility that the cumulative tightening of monetary policy could affect economic activity more than expected, and that further strains in the banking sector could prove more substantial than anticipated. What's going to go on with the banking sector? Who knows? It's very difficult to forecast these things. Participants generally agreed that in light of the lagged effects of cumulative tightening in monetary policy and the potential effects on the economy of a further tightening in credit conditions, the extent to which additional increases in the target range may be appropriate after this meeting had become less certain. So they basically, in May, they said, look, we're not even going to pretend to know what's going to happen to rate increases. It could be anything. And now we've got a little more of a concrete forecast from the Fed in this latest meeting. Seems that the more than a majority of the members of the committee believe that at least 2 hikes will be in order, and one of the members thinks even 4 hikes in 2023 may be in order. Participants generally expressed uncertainty about how much more policy tightening may be appropriate. Some participants commented that based on their expectations that progress in returning inflation to 2% could continue to be unacceptably slow, additional policy firming would likely be warranted at future meetings. Several participants noted that if the economy evolved along the lines of their current outlooks, then further policy firming after this meeting may not be necessary. Well, now it seems that it will be necessary. At least that is the forecast. The economic forecast, remember, this is the May meeting. The economic forecast prepared by the staff for the May FOMC meeting continue to assume that the effects of the expected further tightening in bank credit conditions amid already tight financial conditions will lead to a mild recession starting later this year, followed by a moderately paced recovery. The unemployment rate was forecast to increase this year, to peak next year, and then to start declining gradually in 2025. Wow. So now that the Fed is no longer, with this latest meeting, again, we don't have the minutes yet for the June 13th through 14th FOMC meeting. We know they're no longer forecasting a recession in 2023. However, that leaves the potential for a mild recession, as they call it, in 2024. Leaves that open for a possibility. What's in 2024? Gee, election year. And then unemployment rate forecast to increase this year and to peak next year, to peak in 2024 in the middle of a presidential election. This is not good news for the Biden administration. If you're a Democrat, you don't like this outlook. It's not good timing. And actually, it would be, now that the FOMC's revised their forecast, they're saying, well, mild recession won't come in 2023. It may come in 2024. That's even worse if you're a Democrat, because you would almost rather have the mild recession come now or in the next few months, and so that you could cement a moderate recovery by summer of 2024 and go into the election seeming to have recovered. But if that's not the case, if a mild recession kicks in next year, and then especially if unemployment, I mean, I made the argument that one of the reasons why Republicans did so poorly in the November 2022 election, well, it was due to a number of things, but one of the reasons, people weren't desperate enough, okay? Yeah, inflation was bad in 2022. But unemployment was extremely low. And the stock market was fine for the most part. But the low unemployment rate made a big difference. Well, if unemployment increases this year and then peaks next year, that is not good news for the Democratic Party, because that will be blamed on the current administration. Now, what is a mild recession? Jerome Powell, at his last press conference, again, he's giving a press conference right now as I speak, so I don't know exactly what he's saying at the moment. At his press conference in May, he defined it. He said, I would characterize a mild recession as one in which the rise in unemployment is smaller than has been typical in modern era recessions. The reason for the jumbled words here, this is a literal transcript. He's sort of like me right now. He's talking off the cuff. But a mild recession in which the rise in unemployment is smaller than has been typical in modern era recession. So not like a huge 2008 crash. That's not what they were forecasting here. But one in which, you could have maybe 5 or 6% unemployment, maybe even 7% unemployment, and a correction in housing prices. I mean, if you have a correction in the housing market and even a moderate increase in unemployment, again, that's politically, that won't fare well for the Democrats. So that is all that I have for you today. Very interesting. I did not expect the Fed to come out as hawkish as they were today. I think probably it seems to be the right move, putting aside my objections to the entire philosophy of the Federal Reserve, which of course is built on the assumption that central planning is the best way to organize an economy. But we will see what happens. I hope you all are having a great summer. I sure am. And I'll talk to you next time. Bye.